Welcome back to Alpha Recap. I'm glad you could join us. The markets were officially closed for the day, and we're unpacking what drove the moves. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to cover after a tech-led pullback that shifted flows into defensive corners of the market.
Let's start with the big picture. The broad S&P ETF finished down just under 0.5%. The tech-heavy NASDAQ ETF plunged about 1.8%, and small caps finished down just under 1%. That felt like a growth-led snapback, right?
Exactly. The day was very much defined by semiconductors and mega-cap tech selling off, and that pressured the headline indices even though a handful of defensive sectors attracted buyers.
So what really stands out here is that it wasn't a broad market sell-off. It was concentrated.
Right. The pullback was concentrated in chips and their suppliers. When a bellwether, in this case Samsung, reported weaker earnings and guidance, the whole supply chain reacted. That led to heavy selling in semiconductor makers and equipment firms. And the way chips trade amplifies this. They're sensitive to near-term demand signals and inventory stories. So a single supplier signaling slower revenue or margin prospects can raise the implied risk premium across the sector.
Hold on, say that again. Implied risk premium?
Sure. It just means investors demand a higher expected return to own those stocks because uncertainty went up. If people think demand could slow or margins could compress, they treat semiconductor exposure as riskier, and that shows up as lower prices.
Yeah, that tracks.
Also, technical factors played a notable role today. After a long stretch of outperformance, growth names had stretched momentum indicators and crowded positioning. So when negative headlines hit, you got profit taking, and in some cases, forced deleveraging in futures and options markets. That created a faster move than you might expect from just one earnings miss. When positioning is crowded, bad news becomes amplified.
Let's pivot to the sector winners. Utilities stood out today. What was driving that?
Two big things. One, defensive positioning. Investors rotated toward lower volatility, income-like sectors. Two, specific headlines. Grant announcements, energy storage project funding, and renewed activity around power purchase agreements made utilities and storage-related names look attractive from a cash flow perspective.
Right, so it's not just flight to safety. There were concrete policy and project drivers too.
Exactly. And energy was mixed but constructive overall. Oil pockets showed strength, which helped integrated and exploration names, but clean energy and power transition names reacted to policy commentary and shifts in capital flows.
Short reaction, not what anyone expected.
On the materials side, miners got a lift from permit news at Escondida and a deal around Linus, which reminded traders that commodity-linked exposures can still outperform on idiosyncratic headlines.
And small caps lagged, right? That Russell-linked ETF was down just under 1%.
Yes, small caps were pared back, which matches a broader tactical shift into defensives when growth names wobble. Investors trimmed risk on exposures.
Quick note on banks. There was chatter about Renaissance and M&T Bank. What was that about?
Analysts were parsing coverage notes on asset quality, deposit dynamics, and capital return plans. With rates still relatively elevated versus earlier cycles, every comment about credit or funding tends to create headlines for regional and specialty lenders. Now, on the Fed and macro implications. Today's move looked less like a direct reaction to a Fed announcement and more like the market repricing idiosyncratic corporate news with macro spillover. Still, there are two channels traders watch.
And those two channels are?
First, growth and inflation signaling via corporate profit and hiring trends. If tech demand softens, forecasters could lower GDP or business investment expectations. Second, market-implied rate expectations. Shifts into defensives can change Treasury yields and the shape of the curve, which affects how people price Fed policy in futures.
So persistent weakness in tech earnings could, at least in theory, temper how aggressively markets price future rate moves.
Analysts note that the Fed remains data-dependent, but market dynamics like this can influence the narrative and trader positioning.
Let's make this accessible for listeners who aren't deep in the weeds. What should they watch tomorrow or this week?
Keep an eye on 3 things. 1. Follow-up commentary from U.S. chip makers and equipment suppliers. Confirmation or refutation of that Samsung signal matters. 2. The macro calendar and any Fed commentary or inflation prints. And 3. Commodity and energy moves, because a firmer oil price can support cyclicals even when growth names correct.
Got it. Any specific company-level themes worth noting?
Semiconductors were the day's largest negative. Utilities and storage-related names were the winners. Miners reacted to permit and deal news. Cannabis showed more stock-specific moves tied to strategic deals. And the financial space stayed mixed as analysts dig into asset quality and capital plans. Honestly, I was a bit surprised by how quickly the chip complex retraced. But episodes like this aren't new. Growth-led snapbacks happen after long rallies.
Yeah, absolutely.
Technically, the S&P's modest decline suggested some market resiliency, but the steeper drop in the Nasdaq flagged a problem for momentum-driven strategies that had been overweight large-cap tech.
Short reaction. Breadth mattered more than the headline.
Exactly. The session narrowed as it progressed, which is typical when sector leadership shifts. That dispersion, the differences between winners and losers, is what traders will be watching next.
Quick summary. Give our listeners 3 clear takeaways from today.
1. The pullback was tech-led and concentrated in semiconductors after weaker guidance from a major supplier, which cascaded through the supply chain. 2. Defensive, yield-like sectors, utilities and parts of energy, attracted flows on both policy news and income appeal. 3. Market implications for the Fed are indirect but real. Earnings weakness can feed into growth forecasts and market-implied rate paths, so watch upcoming corporate updates and macro data.
Those are solid. Any final color for traders and listeners?
Expect elevated volatility as markets digest earnings, commodity moves, and Fed cues. Breadth and sector dispersion will likely tell you more than headline indices in the near term.
Perfect. If you want to dive deeper into any of these themes or ask about what we discussed, head over to stockalpha.ai. You can submit questions directly there, and we'll answer them via the Q&A feature.
And for more market analysis and follow-ups, visit stockalpha.ai. We'll be watching chip commentary, treasury yields, and commodity behavior as markets reopen.
Thanks for listening to Alpha Recap. Stay curious, stay calm, and we'll see you next session. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.